Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, SpaceX pivots to a moon city, fueled by Starlink's $15 billion in revenue and a massive XAI acquisition. We'll analyse why this strategic pivot is a turning point for the new space race and how it could affect the future of orbital AI computing. Second, Taiwan rejects a US demand to move 40% of its chip capacity, calling the plan impossible amid tariff threats. We'll explore how this standoff over the world's most critical supply chain could transform semiconductor strategy and US Taiwan tech relations. Third, oil giant TotalEnergies signs a 1 gigawatt solar deal to power Google's AI data centers in Texas. So we'll discuss why this massive deal matters for the energy transition and what it means for powering the AI revolution without breaking the grid. Fourth, a $160 billion IPO boom is forecast by Goldman Sachs, led by AI giants like OpenAI, SpaceX, and Anthropic. We'll examine how this AI-driven boom creates a barbell market and how valuation uncertainty may impact the entire tech innovation cycle. Fifth, a grassroots network uses 3D printing to distribute 500,000 free whistles for an ICE agent alert system. Today, we'll take a closer look at this use of decentralized manufacturing and its implications for grassroots activism and First Amendment legal battles. For years, the story was Mars. Now, forget it. Elon Musk just announced SpaceX is shifting its primary focus to building a city on the moon. In a stunning pivot, Musk declared that while a Mars city is still a goal, the new overriding priority is securing the future of civilization, and the moon is faster. The moon's proximity is a game changer. We're talking about a trip that takes days, not months. This dramatically cuts down mission costs and development timelines, making it a much more practical target for near-term commercial projects. Actually, this pivot aligns perfectly with a massive potential SpaceX IPO, where showing quicker, more predictable progress on the moon is far more attractive to investors than a distant dream of Mars. The timeline is aggressive. An uncrewed lunar landing is targeted for March 2027, with the goal of a self-growing city on the moon in less than a decade. Now, you might be asking, what on earth is a self-growing city? So the thing is, the idea isn't to ship pre-built habitats from Earth. Instead, the plan relies on something called in situ resource utilization, or ISRU. This is a fancy term for using local materials. Imagine autonomous robots, maybe even versions of Tesla's Optimus, 3D printing buildings using lunar dust or regolith as a primary construction material. This is a radical departure from the way NASA or the European Space Agency have traditionally planned missions. This isn't just about exploration, it's about a race. The US faces intense competition from China to return humans to the moon for the first time since the Apollo 17 mission in 1972. And this new space race is totally different from the one in the 1960s because this time, it's not just nation versus nation. China has a state-controlled plan to land its own astronauts on the moon by 2030, developing its own rockets and landers. The US, on the other hand, is increasingly relying on private companies as instruments of its national strategy. SpaceX isn't just a contractor, it's a critical partner in the Artemis program, and its commercial goals are now intertwined with America's geopolitical ambitions in space. But that's not the whole picture. The real turning point is a massive acquisition that just became concrete. A while back, we walked through the rumoured SpaceX XAI tie-up and even the bigger Musk Incorporated thought experiment. The latest development is that SpaceX has actually acquired XAI, and those trillion-plus valuations we discussed are now attached to a real corporate structure with IPO chatter in the mix. Just before this announcement, SpaceX acquired XAI, the artificial intelligence company also led by Musk. The combined valuation, a staggering $1 trillion for SpaceX and $250 billion for XAI. The XAI acquisition isn't just about an app on your phone. A while back, we laid out the orbital data center play and the ugly physics behind it. In a vacuum, you can't use fans. Heat only leaves by radiation, so you'd need massive radiator systems. Off-the-shelf GPUs get pummeled by cosmic rays, pushing you toward expensive radiation-hardened processors. We also talked about the orbital variant filings aimed at constellations of compute nodes with their own solar arrays and high-speed laser links. NASA has already hit roughly 200 gigabits per second on optical links. Musk has now connected that playbook to a lunar angle. Think about it. Data centers on the moon could potentially have access to uninterrupted solar power while using the cold vacuum of space for radiative cooling. This would be a revolution for AI and cloud computing, but as we've discussed before, it comes with incredible engineering challenges like protecting electronics from cosmic radiation. On top of that, SpaceX is now reportedly eyeing what could be the largest public offering in history, hoping to raise as much as $50 billion. We previously noted how reframing SpaceX as an AI compute provider could be a powerful catalyst for any listing today's Moon Plus compute narrative fits that thesis. This all begs the question, what's footing the bill for this lunar ambition? If you think it's just taxpayer money, think again. Musk went on the record stating that government agency NASA will constitute less than 5% of SpaceX's revenue this year. He added that the vast majority of SpaceX revenue is the commercial Starlink system. What's really powering this lunar ambition is Starlink's bottom line. In 2024, Starlink already made up over half of SpaceX's revenue, but projections for 2025 are even more stunning, with Starlink expected to bring in around $15 billion, accounting for nearly 2/3 of the company's entire income. That's a massive, predictable stream of cash that can be poured directly into these lunar plans. We broke this down a while back when private trades vaulted SpaceX's valuation on the strength of launch plus a fast-scaling Starlink. Today's numbers just reinforce that story. The mission has changed, the timeline has accelerated, and the money is staggering. With its Starlink system fueling a massive war chest, SpaceX is no longer just a NASA contractor. It's a commercial empire building its own future on the moon. And this creates a fascinating new problem that goes beyond engineering. The 1967 Outer Space Treaty forbids any nation from claiming sovereignty over the moon, but what happens when a private company, not a country, builds a city there? This opens a huge legal grey area around property rights, resource claims, and even who's in charge if a crime is committed. We are entering a new frontier, and the rules have not yet been written. Speaking of geopolitical races with huge legal implications, another high-stakes standoff is brewing in the tech world. A top Taiwanese official just went on the record with 2 words for the United States: impossible. That's the direct response to a US push to move 40% of Taiwan's semiconductor capacity to America. In an interview, Taiwan's top negotiator said she made it very clear to Washington that the island's entire chip ecosystem, built over decades, simply cannot be relocated. Now, when she says the ecosystem is impossible to move, it's about more than just the factories. We're talking about a dense, hyper-efficient network of hundreds of specialized companies. Think of it like a rainforest where everything depends on everything else. You have firms that supply ultra-pure chemicals, others that build precision tools, and experts in packaging and testing, all located within miles of each other, often in a single area like the Heishan Science Park. This proximity allows for collaboration that takes hours, not days or weeks. You can't just airlift a rainforest and expect it to survive. A while back, we broke down how leading edge output is tethered to one crucial piece of that rainforest: EUV lithography tools from ASML, the only game in town. Even tiny contamination in those EUV mirrors can halt production. That fragility is exactly why Taipei argues you can't uproot the rainforest on a timetable set elsewhere. This isn't just a polite disagreement. It's a high-stakes standoff over the world's most critical technology. U.S. Commerce Secretary Howard Lutnick laid out the American position bluntly, stating, "You can't have all semiconductor manufacturing 80 miles from China." That's just illogical. His stated goal for the administration is to capture 40% market share in leading-edge chip manufacturing. Continuing our last discussion about the lithography bottleneck, the latest twist is that Washington's target runs straight into EUV tool availability and lead times, the gating factor for any leading-edge ramp. And that term leading edge is crucial. This is where the situation takes a more complex turn. We're not talking about just any computer chip. The US is specifically targeting the most advanced chips, those at 7 nanometers and smaller. These are the brains behind everything from AI and supercomputers to the most powerful smartphones. Taiwan's TSMC currently has a near total global dominance in this specific category, holding over 70% of the market for these sub-7 nanometer nodes. So when the US says it wants 40%, it's not asking for a piece of the pie. It's demanding a massive slice of the most valuable, most difficult to produce part of the entire industry. And as we've noted before, wafer output is only half the battle. Advanced packaging has become a choke point too, and much of that capability is embedded inside Taiwan's existing ecosystem. However, if you zoom out, you'll see another layer of strategy at play. In a previous interview, Lutnick attached a stunning threat to that demand, saying if the 40% shift doesn't happen, tariffs on Taiwan would likely rise to 100%. We've also talked about how a slow US fab ramp makes the world more dependent on a few leading nodes, and by extension, on ASML delivering on time. Tariff brinkmanship doesn't accelerate tool shipments or talent pipelines. Interestingly enough, this hardball tactic is a uniquely American approach right now. The European Union, for instance, also has its own CHIPS Act, aiming to boost its own production, but its strategy is built on incentives and partnerships, not explicit threats to a specific partner. The U.S. strategy of linking production shifts to tariff threats, risks, alienating a critical ally, turning a potential partnership into a coercive standoff. This isn't even the first time the US has pushed for a massive shift. Previously, Washington floated an even more aggressive proposal, a 50-50 split in chip production, which Taiwan also rejected. While Taiwan is pushing back, it is still making moves. The world's largest chip maker, TSMC, is investing a staggering $165 billion to build new factories in Arizona. A while back, we also talked about TSMC's CapEx surge and how a big slice flows through ASML's order book, because those EUV systems, including the next-gen high-NA gear, are the hard limit on how fast any leading-edge fab, Arizona included, can ramp. Believe it or not, building those chips in America comes with a hefty price tag, what some are calling a geopolitical premium. Estimates suggest it could cost up to 30% more to produce a state-of-the-art wafer in Arizona compared to Taiwan. This is due to higher labor costs, supply chain issues, and construction expenses. So who pays this premium? We all do. It's a cost shared between US taxpayers funding subsidies, tech companies like Apple and Nvidia absorbing higher prices, and ultimately consumers who may see the cost of their electronics go up. And as we discussed, higher costs and longer build times stretch the timeline, deepening the interim dependence on Taiwan's existing nodes and on ASML's delivery cadence. However, Taiwanese officials are drawing a firm line in the sand. They insist that while they will expand their presence in the US, their core industry will remain firmly rooted at home and will only continue to grow there. And this expansion is more than just building factories. Taiwan is actively engaged in knowledge sharing. For example, TSMC has launched a registered technician apprenticeship program in Arizona and is dramatically expanding its US internship program from just 16 students to over 200. They are partnering with American colleges to train a local workforce. The goal is to build up US capabilities without creating a brain drain of their own essential engineering talent from Taiwan. That workforce build-out matters because, as we noted before, you don't swap out a Formula One engine mid-race. Tooling and talent have to ramp together. The message is clear. The United States is demanding a seismic shift in the global tech landscape, backed by the threat of massive tariffs, and Taiwan is publicly declaring that it will not happen. A few days ago, we talked about how fragile the tool chain is and how dependence on ASML is only deepening. Today's update from Taipei underscores that reality. Without the tools, packaging, capacity, and proximity we've discussed, that 40% relocation remains, using their word impossible. That insatiable demand for cutting-edge chips we just talked about has a flip side, an equally insatiable demand for electricity. Now get this, one of the world's largest oil companies just signed a massive deal to power Google, but it's not with oil or gas. French oil major TotalEnergies is building brand new solar farms in Texas for one reason, to power Google's electricity-hungry data centers. A while back, we talked about the AI boom taking a secure power first, clean it up later path with new gas plants. This is the counter move, locking in clean generation up front for a 24/7 digital load. We're seeing TotalEnergies doubling down, while at the same time, competitors like Shell and BP are actually scaling back their renewable energy ambitions. They are pursuing what the industry calls an integrated power strategy, betting that they can profit by generating and selling massive amounts of electricity directly to huge customers like Google. It's a bold move that sets them apart from their biggest competitors. And remember our earlier question, who takes the risk of building all this power? In some regions, we said it was falling on utilities and ratepayers. Here, those long-term contracts suggest big tech is directly underwriting new capacity instead of leaving it to the grid to figure out later. And the scale of this deal is a bombshell. We are talking about 1 gigawatt of new solar capacity. A single gigawatt is an enormous amount of power, but what really brought this to a head was the relentless 24/7 demand from artificial intelligence. Unlike your home, which uses power intermittently, an AI data center is a power-hungry beast that never sleeps. This creates a massive challenge. The sun doesn't shine at night, so pairing an intermittent power source like solar with the constant demand of AI is a huge engineering puzzle. We previously flagged that the fast route has been new gas capacity to cover that gap. Today's deal leans into building clean supply first and then solving the round-the-clock piece. To put that in perspective, over 15 years, that's enough to deliver 28 terawatt hours of renewable power. This is officially the largest renewable power agreement TotalEnergies has ever signed in the United States. So what's driving this unlikely alliance between big oil and big tech? The answer is artificial intelligence. The deal is explicitly designed to meet the skyrocketing electricity demand driven by AI. A while back, we noted the International Energy Agency's warning that data center consumption could nearly double by 2030. This is what a concrete response to that looks like. And the numbers are staggering. A recent Bloomberg NEF report warns that US data center power demand is set to explode, growing by a massive 36% more than experts predicted just months ago. This spike is almost entirely because of AI. As we said before, that means individual campuses soaking up hundreds of megawatts and utilities rewiring grids around that load. Now, here's where it gets interesting. While other oil majors have pulled back, TotalEnergies is bucking the trend, continuing to invest heavily in renewable energy. They are expanding their power business in deregulated markets like Texas, seeing huge opportunities where price volatility can create attractive returns. We compared different models a while back, America's speed-first approach, Europe's push for sovereign AI built on efficiency and renewables, and the Gulf's capital-led play. This move nudges the Texas story a bit closer to that cleaner path without losing the speed. And after all, this is happening in Texas, home of the notoriously fragile ERCOT power grid. The grid operator has seen requests from large power users like data centers absolutely explode, jumping from just 41 gigawatts a couple of years ago to over 136 gigawatts today, adding a massive constant power drain for AI while trying to supply it with intermittent solar power puts incredible stress on the entire system, raising serious questions about grid stability for everyone. And as we warned earlier, when the bet on AI demand goes wrong, fossil projects can become stranded assets. This is why shifting to new build renewables under direct contracts matters for who holds the bag. And this isn't just about powering Google's servers. A Google director stated this partnership adds necessary new generation to the local system, which will boost the amount of affordable and reliable power for the entire region. So that phrase, adds new generation, is incredibly important. In the world of corporate green energy, this is called additionality. The key question is whether these solar farms would have been built anyway, or if Google's investment was the direct and necessary cause for their existence. Proving this additionality is the gold standard for making sure a company's green claims are actually helping build a cleaner grid, not just taking credit for it. We previously cautioned that the power now gas track can lock in emissions for decades. Additionality points in the opposite direction, new clean plants instead of new fossil ones. This isn't just a power deal. It's a signal that the insatiable energy appetite of the AI revolution is forcing even the biggest names in fossil fuels to make colossal bets on a green energy future. An oil giant is now a key player in powering the world's most advanced technology with the sun. And think about the global picture for a moment. This is a French national energy champion building critical infrastructure on American soil to power US tech giants' AI ambitions. This transatlantic dependency is a stark contrast to China's strategy, which focuses on building a completely self-reliant domestic tech and energy supply chain through initiatives like its Eastern Data, Western Compute project. We recently highlighted another wrinkle, Tesla's audacious plan to stand up 100 gigawatts of US solar manufacturing by the end of 2028 to counter China's dominance over upstream steps like wafers and cells. China controls roughly 97% of wafers and over 80% of cells. That's the other fault line here. Not just who buys the power, but who controls the supply chain that makes the panels. Meanwhile, Europe keeps pushing its sovereign AI vision, anchored in efficiency and renewables. Different paths, same destination, keeping the AI era powered without breaking the grid or the planet. We were just talking about the massive energy costs of the AI revolution. Now, let's shift our focus to the staggering financial side of it. Goldman Sachs just dropped a number that is an absolute bombshell for Wall Street. $160 billion. The firm is forecasting a record-shattering rebound for US IPOs, predicting proceeds will quadruple by 2026. Continuing our last discussion about AI-driven repricing in software, this call isn't happening in a vacuum. It's arriving just as markets reassess where profits accrue in an AI-first economy. This isn't just an optimistic forecast. It's a signal that the biggest, most valuable private companies in the world are finally getting ready to go public. At the center of this investor attention are the names everyone is watching: Elon Musk's SpaceX, ChatGPT maker OpenAI, and its major rival Anthropic. A while back, we walked through how Anthropic's Claude, with that massive context window, can ingest entire code bases and thousands of pages at once, exactly the kind of step change that turns these names into the gravitational centers of the next cycle. According to Goldman Sachs, the potential public debuts of these few titans will likely define the scale and tone of the entire next IPO cycle. So the thing is, these companies have raised billions in private money. Why go public now? The private markets might not be big enough anymore to fuel their ambitions. As we've discussed before, foundational model training and inference at that scale are capital black holes. The capital needed for the enormous computing power and research to build next generation AI is staggering. For instance, some reports suggest OpenAI's long-term roadmap could require over $1 trillion. For these companies, an IPO isn't just a choice. It's becoming a necessity to get the massive funding they need to keep growing. This comes as the market is already showing signs of life. The number of IPOs is expected to double this year, with firms like AI equipment maker Forgent Power and biopharmaceutical company Icon Therapeutics already raising about $5 billion. NVIDIA rival AI chip maker Cerebras Systems is also a major player to watch. And Goldman's view is that while software and healthcare names will dominate in count, most of the dollars will concentrate in a handful of late-stage AI and tech giants, another version of that barbell we talked about. The intense focus on these mega IPOs creates what some analysts are calling a barbell market. Imagine a barbell with huge weights on each end. Those are the giants like OpenAI and SpaceX, and a very thin bar in the middle. That thin bar represents these other innovative mid-sized companies. A few days ago, we noted investors rotating out of traditional software as AI drained old moats. In a barbell phase, that pressure on the middle only intensifies. The risk is that nearly all the investor capital and attention gets sucked up by the giants, potentially starving these other important companies of the funding they need to grow. So while the overall market might look hot, the health of these second-tier companies is a much better indicator of the true breadth of the recovery. If that was just the appetizer, the main course is the major risk buried in this blockbuster forecast. The analysts also issued a stark warning about an early year sell-off in software stocks, which has underscored serious valuation risks. We flagged that a while back. One chief investment officer called it an awakening to AI's disruptive power. We've already seen real-world proof points. Klarna replaced roughly 1,200 SaaS tools, including Salesforce, with its own internal AI platform, and selling can beget more selling when those traditional moats start to look porous. The challenge with these valuations is that for foundational AI companies, traditional math just doesn't work. You can't just look at current revenue. Analysts are trying to invent new ways to value them, looking at things like the quality of their data, the scalability of their AI models, and how quickly they innovate. It's also the AI dumb pipe risk we talked about. If a software product becomes a fancy wrapper around someone else's model, the value leaks to the model provider. They're trying to value the unknowable future, and that makes the whole situation incredibly volatile. When we place the software sector's massive IPO backlog alongside this valuation uncertainty, the contradiction becomes clear. Continued volatility and a lack of corporate confidence could threaten the entire rebound. As we said a while back, the comparison to the early 2000s is tempting but misleading. This isn't froth popping as much as it is the market repricing durable, profitable businesses whose per-seat economics may be colliding with agents and automation. This all points to one massive takeaway. The projected boom is not a story about hundreds of small companies. The forecast shows the bulk of this record-breaking $160 billion will be driven by just a handful of late-stage tech and artificial intelligence giants. making their success the linchpin for the entire market. This level of concentration is unprecedented, actually. During the dot-com era, the top tech stocks made up about 15% of the S&P 500. Today, just a handful of tech giants, the Magnificent Seven, account for over a third of the entire index. We've already seen how fragile that concentration can be earlier this year. Microsoft briefly lagged its mega cap peers as new AI tools sent shockwaves through software names. It means if one of these giants stumbles, the shockwaves could be felt across the entire economy in a way we've never seen before. And there's another layer to this. Companies like SpaceX and OpenAI aren't just businesses. They're seen as national champions in the global tech race, particularly against China. So what happens when they go public? Suddenly, they have to answer to global shareholders who demand short-term profits every quarter. This could create a major conflict with their long-term strategic national security roles. It raises serious questions about foreign investment and influence, a concern that has already been raised by US lawmakers. The success of this IPO boom isn't just a financial story. It has massive geopolitical implications. Speaking of massive centralized tech giants with geopolitical weight, our final story today takes us to the complete opposite end of the spectrum, a decentralized grassroots network using simple tech for a powerful purpose. The story begins with a decision that caught everyone by surprise. A nationwide network has shipped 500,000 free 3D printed whistles to 49 states. Their only purpose? To alert entire neighborhoods when ICE agents are in the community. This is a perfect example of how consumer 3D printing has completely changed the game for activism, you know? It has matured so much that it's created what you could call an activist's microfactory. It democratizes manufacturing, allowing groups to produce essential items on demand, completely bypassing traditional supply chains. We've seen this used to print prosthetic limbs for children in war-torn areas and even to reconstruct historical artifacts destroyed by extremists. It's a powerful tool for rapid, decentralized response. And the architects of this massive grassroots operation aren't who you'd expect. The effort is being spearheaded by two best-selling romance novelists, Kit Rocha and Courtney Milan. They've helped create a decentralized group of volunteers who are turning their home 3D printers into hubs for community action. The numbers are staggering. The group shipped 200,000 whistles in the first week of February alone, with volunteers printing them for as little as 5 cents a piece. This isn't just a small project. It's a rapidly scaling nationwide supply chain built on Signal chats and Amazon wishlists. The situation presents a fascinating duality. On one side, using platforms like Amazon and GoFundMe gives movements incredible scale, while on the other, it exposes a huge vulnerability. Movements can face risks like deplatforming, where a company can suddenly shut down their accounts, or algorithmic suppression, where their content just stops being seen. It raises a critical question. Can you build a truly anti-establishment movement on a corporate foundation? The tipping point for this explosive growth came after the death of Renee Good in Minneapolis. Organisers say that in a moment of widespread pain and powerlessness, they offered a tangible action. The network of printers surged from just 20 members to over 180 almost overnight. This has put them on a collision course with critics, with one provocateur calling the devices hearing loss causing machines that terrorists use against ICE. But the organisers are walking a careful legal line. Co-organiser Courtney Milan, a former US Supreme Court law clerk, frames it as a First Amendment issue, stating, "If we impede ICE simply by being there and observing them, it is ICE being too ashamed to do unlawful acts when being watched by people." And the legal strategy here is incredibly sophisticated. By framing the whistles as tools to exercise First Amendment rights, the right to observe and record public officials, they are standing on solid constitutional ground. However, the government could counter this by framing the entire operation as a criminal conspiracy to impede or injure federal officers, using a statute known as 18 U.S.C. Section 372. What's wild is that based on a Supreme Court precedent, United States versus Failer, prosecutors wouldn't even have to prove the organisers knew the agents were federal officers. This sets up a fascinating legal battle between free speech and federal authority. While some question if a whistle can stop a raid, organisers see it as a symbol of connection and mutual aid, a way of saying you are not alone. That reminds me, in an age of live streaming and surveillance apps, an analog tool has unique advantages. A whistle is untraceable. It can't be hacked or tracked. It sends an immediate hyperlocal alert that isn't dependent on a cell signal or battery life. Its simplicity is actually a strategic reaction to the risks of digital-only methods, which are vulnerable to surveillance and interception. For them, the message is clear. In the words of Milan, the whistle says, "We will stand up and we will watch, and we will judge you and we will remember and we will witness, and you will not get away with it."
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.